we've had a lot of discussion about the impact of policies and quantitative easing and a variety of issues over the last 6 years. Would it be possible, or maybe such a number exists, but you and I both know in the most simple definition of economics, economics is about taking finite resources and most efficiently allocating them among infinite demands, the most elementary description of economics. Over the course of the last 6 years, where the policy decisions have been made to, some would say, artificially restrain interest rates, in effect dramatically causing interest rates to be less than they would normally have been, and at the same time having an aggressive buying program on certain assets that would in effect hold up their value above and beyond what they normally would be worth, that there is a cost there. I occasionally have constituents, especially in the older part of my constituency, who have money either in bonds or in bank deposits because they want absolute safety, absolute security, who question me about the cost to them of this program. Would it be possible for someone in your staff to quantitatively produce a number about what the transfer of value or wealth or whatever you want to describe it over the last 6 years has been from one class to another of asset holders? I think it'd be a fascinating number because there is a price that has been paid for this technique to try and keep the economy alive.
Well, it's been a tough period for savers, and I've certainly heard and interacted with many groups of retirees, especially who were looking to supplement their retirement income with interest from safe assets, and it hasn't been possible for them.
It reminds me of my period as a college student in the late 70s and early 80s when we went through what some would define as the superinflationary period, where there was a dramatic shift from dollar-denominated assets over to anything that was real estate or stocks and bonds, that kind of a thing. And there was a price paid by that part of our society who was most thrifty, most careful, most cautious, most concerned about their old age. I see that scenario again, and I would like to have, if it's possible, to generate a number.
I agree with the fact that it's been hard for savers, but I don't think it's right to think about this as some arbitrary policy the Federal Reserve put into effect. There is an underlying economic reality that we have to address, and that underlying reality is that there are many people who are looking to save, and they would like to save in a way that's safe, but the rates of return they can earn depend on the strength of demand for those funds to borrow and spend.
But, Chair, somebody's paid the economic methadone that we've been existing on for 6 years.
I don't think it's methadone. I think it's a reflection of an economy where the demand to borrow has been weak, and we are living in a market system, and the rates of return that savers get has to depend on the strength of demand for the funds they want to supply.